Most investors treat the economy, the stock market, and their portfolio as three separate things. They are not, they're one chain. And the part most investors miss is that the chain moves before you see it, often by months. In this video, I break down the chain reaction from economy to market to your funds, why markets price the future, not the present, what different fund types need from the economy to perform well, and the one framework that keeps you positioned for a range of outcomes rather than gambling on one. Now, let's discuss how the economy sets market conditions. The economy is the starting point. Three things drive almost everything else: inflation, interest rates, and growth. When inflation stays high, central banks keep rates elevated to slow it down. High rates make borrowing more expensive for businesses and consumers. That squeezes corporate profits, slows spending, and eventually reduces earnings. Markets react not to where the economy is today, but to where they think it is going. When growth is accelerating, corporate profits tend to rise, investor confidence builds, and risk assets benefit. When growth slows, the opposite happens. The critical point is that markets do not wait for this process to complete. They price the expectation of it, often months before the data confirms what's happening. Understanding the economy is not just about reading news. It is about understanding the conditions your investments are already operating inside. Now, it's also important to understand why markets move before the economy. A weak economy doesn't automatically mean falling markets. A strong economy doesn't automatically mean rising markets. What matters is whether the outcome is better or worse than what the market was already expecting. This is the most important and least understood principle in investing. Markets are a discounting machine. They are constantly trying to price the next 6 to 12 months, not what's happening right now. If inflation cools but stays above target, markets may still be nervous because the expectation was for the market to fall further. If growth slows but not as much as feared, some sectors can perform well even inside a weak economy. If rate cuts begin, different parts of the market respond differently depending on how sensitive they are to the cost of money. The investor who waits for certainty, who waits for the economy to look obviously good before investing, almost always misses that move. The clearest proof of this is 2020. In March 2020, global markets collapsed as the pandemic hit. The S&P 500 fell 34% in 33 days, the fastest bear market on record. Unemployment was rising. Economies were shutting down. Every economic indicator was pointing in one direction. Markets bottomed on 23rd March 2020. They did not wait for the economic data to improve. They did not wait for unemployment to peak. US unemployment actually hit its highest point, 14.7%, in April 2020, 1 month after markets had already turned. By June 2020, the S&P 500 had recovered 50% from the bottom. US GDP for the second quarter of 2020, published in July, showed the worst quarterly contraction since records began. The economy was at its worst. The market was already 5 months into its recovery. The investors who waited for certainty, who waited for unemployment to fall or GDP to recover before putting money to work, missed the entire move. Understanding the economy and markets is only useful if that changes how you think about your funds. Different fund types are built for different economic environments, and understanding that match or mismatch is where most retail investors are operating blind. If you hold equity funds, corporate profits matter. Growth-oriented equity funds need a growing economy to deliver their best returns. Quality equity funds, those holding businesses with strong balance sheets and consistent earnings, tend to hold up better when growth is uncertain because their underlying businesses are less dependent on economic expansion to remain profitable. If you own bond funds, interest rates matter directly. When rates rise, bond prices fall. When rates peak and begin to fall, bond funds benefit. The direction of rates, not just the level, is what matters for bond fund holders. If you hold cash or short-dated instruments, high rates improve your nominal return, but inflation can erode that in real terms. Cash can feel safe and still lose purchasing power if inflation runs above your yield. The question is never simply, is the economy good or bad? The question is, which funds are built for the environment we are actually in? The biggest mistake is reacting too late. By the time everyone agrees that the economy is slowing, markets may have already priced that in. By the time rate cuts are fully expected, much of the benefit may already be reflected in bond and equity prices. By the time investors feel confident enough to invest again, the best entry point may have passed. This does not mean guessing the future. It means not waiting for the past to become obvious before acting on it. A strong portfolio is built around 3 principles. Do not depend on one economic scenario playing out exactly as expected, and do not assume one fund type will perform well in every environment, and do not make every decision based on the most recent headline. Build around resilience, a mix of assets designed to survive different environments, a clear understanding of what each fund is meant to do, and discipline to separate short-term market noise from long-term portfolio reality. The economy is not background noise. It shapes markets. Markets shape your returns. And markets move before the economic data makes any of it obvious. The investor who understands that chain can position ahead of it. The investor who waits for certainty arrives after the move has already happened. Here is my question. Does knowing that markets price the future change how you currently think about your portfolio, or do you still find yourself waiting for certainty before acting? Let me know in the comments. I'll see you next time.